Hey, thank you for taking the time to click on today's video. Today we're going to be discussing estate planning, and more specifically, I'm going to give you a place to start with your estate planning. For most of my clients, at least in the last 2.5 decades, it seems as though everyone understands just how important estate planning is, but we all have plausible excuses why we're not doing it. Maybe it's something that is going to invoke really hard questions and maybe some really tough decisions. Maybe it's going to be expensive and we don't know exactly how much it's going to cost us. You know, it takes a lot of time to gather all that information, and what questions am I going to ask? Or the big one, I know it's important, but I just don't have the time, and who would I trust anyway? Well, estate planning is something that you have to prioritize, and it's not one of those shoulds, it's one of those must things in our life. But I'm going to show you where you can begin so that you can start understanding that estate planning is a very broad thing, but it's something that you can start to do yourself and you can do it at home. The first thing that I'm going to recommend is that estate planning needs to begin with your own financial accounts. You know, first we need to identify that in most of our lives today, we have multiple different types of money. And the first and probably most popular that people have the most of is going to be the pre-tax accounts. Now, this is important to understand because pre-tax accounts could be anything from a 403b to a 401k to a traditional IRA, a 457 plan, a simple IRA. The list goes on and on. These are going to be generally retirement programs that are provided to us by our employer, or that maybe we have worked for an employer, we had a retirement program, and then we roll it over into an individual retirement account or an IRA. So what happens to these dollars is they're basically never taxed until we begin to take money out of them. And the government is basically saying, listen, we won't tax the seed that you put into the account, but we do want to tax the crop. And so it's going to be taxable to you, and it's also going to be taxable to your spouse if you predecease and you list that spouse as a beneficiary, and it's also going to be taxable to your kids, although they're going to be required to have all of the money out of that account by the end of 10 years after your death. The second kind of money that we have the most, I would say, in abundance in our life is going to be the post-tax money. This is money that we've earned in creating income for ourselves. We paid the income tax on, and now it's just pure principal. Now, that money is money that can be invested and also passed on to children. The third money is the very best kind of money, and this is Roth IRAs. This is tax-free money. It could be a Roth in your 401k, it could be a Roth that you just have as an individual retirement account, but this is going to be totally tax-free to you. It's going to be tax-free to your spouse. It's going to be tax-free to your kids. So why is number one most important? We need to understand what kind of money it is, because we need to understand the ramifications of what's going to happen with our spouse and with our children. The next thing that we need to understand is that estate planning begins at home with beneficiary designations. I cannot begin to tell you how easy it is for individuals just to take beneficiaries and mitigate and make them small. The reality is that if you have a bank account, if you have CDs, if you have annuities, if you have life insurance, if you have brokerage accounts, if you have employer retirement programs, all of those financial institutions and accounts have the capability of you directing a beneficiary to that account or beneficiaries. This means that I have the ability of being able to list who I want to receive these dollars. Banks very rarely will ask you to list a beneficiary to a CD. Banks will very rarely be thorough in asking you your checking, your savings, your money market fund. Do you want to list this as a TOD, a transfer on death, a POD, a pay on death? Who do you want receiving this money in the event that you pass away? So it is up to you to be proactive and to ask that institution for that beneficiary designation form. In addition to that, life insurance is beneficiary driven, annuities are beneficiary driven, brokerage accounts are beneficiary driven, and this is important that we wrap our mind around beneficiaries because, believe it or not, your beneficiary designations supersede any will. They supersede any trust. They supersede any estate plan that you may spend thousands of dollars with an attorney setting up. So beneficiary directives are your responsibility. They're absolutely free to be able to establish so that you can direct this money whoever you want to receive it. And don't use dollar amounts, use percentages, because we don't know exactly how many dollars you're going to have by the time you die. So if you have $100,000, you have 4 kids, don't say, well, each kid gets $25,000, say each child receives 25%. This way, whether it's $100,000, $200,000, or $50,000, that money is still being divided equally the way that you want it to be directed. In addition, if you have grandchildren and you want them to receive something, should something happen to one of your children, make certain to use the terminology persterpes, P-E-R-S-T-I-R-P-E-S. It's a Latin term which means to follow the bloodline. So God forbid you lost a child, then you passed away, that child's share is then going to be passed on to their children instead of to their siblings. Number 3 is direct descendant qualifying gift, or do I send it to my trust? Well, here's the thing. Trusts are really good at receiving post-tax dollars. Those dollars that you've earned, you've already paid the income tax on, now it's principal. However, I really try to refrain clients from taking anything that would be, say, a traditional IRA or 401k and moving that money into a trust. Because oftentimes trusts today do not have what I call qualified language or qualifying language. And what this means is, if I take an IRA and I put my IRA, I direct that IRA when I die into my trust, it has the potential of invoking trust taxes, which are at the tune of 39.6%. So believe me when I say it is best to take Roth IRA dollars and pre-tax dollars and direct those to your beneficiaries directly. You're basically taking that IRA, you're giving it to your son, you're giving it to your daughter, your children in general, and you're taking the post-tax money and you're using the trust as the qualifying mode of transportation to give that to your children, your grandchildren, charities that you wish to be able to support when you pass away. And then institutions. Do not take it for granted that because you have a great relationship with your bank or even your financial advisor is a great guy or gal, or you know what, that life insurance company, they've been around forever, they know how to do business. Do not ever take it for granted that the institutions are going to give you good information with regards to how to dispose of your assets and where these dollars need to go when you pass away. In fact, for them, simplicity is the name of the game. For them, taking the easy way out and just doing the absolute bare minimum is absolutely in their wheelhouse. Yesterday, I was dealing with an older couple in their late 70s. They had 8 different accounts that they wanted to have a second opinion on. And as we were going through not only looking at what they had their money in and how much they had and what kind of money it was, we also reviewed beneficiary directives. And guess what? Only one of their accounts out of all 8 even had contingent beneficiaries listed. What is a contingent beneficiary? If I die, it goes to my primary, which is my spouse. If living, otherwise, my children as contingents. 1 out of 8. So do not rely upon institutions. This is something that you personally have to do for yourself to see to it that it's done and it's done correctly. So I hope today has helped you understand that estate planning can be very broad, and it can be very, very simple. And for most of the individuals that I work with every day, the first thing that I want you to start with is your financial accounts. Start with that, get some momentum built, and then you can move on to things that are more audacious, things that are more comprehensive, like trust planning, POA planning, and things of that nature. Hopefully you've liked this little video. If you have and just been informative, give us a thumbs up. If you like our little weekly videos, I encourage you, hit that subscribe button, that little bell. We'll remind you every time we have a video. And until next time, remember, I'm Matthew Johnson, and it's up to you to make today a great day. Thanks so much for watching.